Well, aloha and good morning, folks. It's your boy, Jason Scott, Jason C. Scott with Task Force Mortgage Team. And today we're going to talk about what is the VA IRRRL, the VA IRRRL, or Streamlined Refinance. Now, some of you out there, if you've bought your home recently within the last few years, or just bought your home within this last year, especially in the last 24 months, you've been part of that group of folks that have had to buy a home at a higher interest rate, right? And right now, the Fed has finally realized that, hey, they need to start cutting rates, bring stuff back down. They feel they've got inflation under control. So this is a huge opportunity for you to have your VA home loan benefit. Now, what is the IRRRL? It's basically a streamlined refinance, very little documentation, no appraisal required, and at minimum, we have to reduce your rate, your current rate, by at least 0.5%, right? At least that. A lot of times people will try to get more. Obviously, it just depends on what the market will dictate. And the recoup for the closing cost involved in that loan has to be 36 months or less. You're like, well, Jay, what the heck does that mean? Well, let's just do a simple scenario. Let's say you have a $400,000 loan on your home, and it's at a 4% rate currently. And then let's say rates drop to 3.5 or better. Okay. Now, granted, those aren't what the real rates are right now. It's just to help keep the number simple. So if you drop to 3.5, that meets the minimum 0.5 point requirement. Now, let's say by dropping it 0.5 point, it reduces your payment $150 per month, right? Now, a lot of people are like, well, hey, $150, that's not much. Well, hold on, we'll get to that in a minute. So as long as your total closing costs don't exceed, I want to say 4,500, let's just double tap here. If we go 4,500 divided by 150, yeah, that's 30 months. So yeah, so technically, let's try this again. Let's see. And sorry, I'm doing this on the computer as I'm with you. I would say let's go 5,000 divided by 150. That's still 33. So yeah, like if you're around $5,200 or less in that scenario, or sorry, 53. Basically, yeah, 5,450, $5,500 or less in closing costs, then you meet that 36-month recoup, meaning the amount of savings per month divided into the total closing cost of the loan, right? Now, the other cool thing about the Streamline is if you remember when you purchased your home, you know, there's always closing costs because there's third parties involved, lenders have their fees, so on and so forth. So of course, in the Streamline, there's closing costs as well, but in your purchase, if you were a first-time purchase, your VA funding fee was 2.15%, where now it's only 0.5, right? Unless you're funding fee exempt, which you pay $0. And then also you may have had to come to the table with some cash, or you had the seller contribute monies to help offset or pay your closing costs, or you took a higher rate and your lender said, oh, we're going to roll the closing cost into the loan, which that's another video for another time that we'll explain, but you can't technically ever roll closing costs in the loan. There's only one closing cost, that's the funding fee. You just basically took a higher rate that came with some lender credit to pay those closing costs. Well, with the Streamline, you actually can roll the closing costs into the finance loan amount. So you don't have to come to the table with anything. In fact, the Streamline is set up to where you can get up to $500 back at closing as well. Now, going back to that $150 savings. Somebody's like, well, Jay, that doesn't seem like very much. Well, let's think about this. Let's say you've owned your home for 1 year. Now, typically before you can use the Streamline IRRRL, you have to have made 7 on-time payments on your current loan before you can actually close on a new refinance. That's to help make sure that you have a net tangible benefit, that there's an actual, this is going to put you in a better position so people don't just try to churn your loans over and over and over again, right? So you meet the minimum requirements and you say, okay, well, $150 just doesn't seem like much. Well, here's the thing. If you're used to your payment as it is right now, and you can reduce your rate to where it reduces your payment $150, well, keep making the same payment that you're making, because that extra $150 now goes towards the principal, right? Now, the other cool thing is when you close on the loan, typically your loan officer is going to set it up to probably close to the beginning of the month. So that way you don't have to make that month's payment on your current loan. So there's one payment. You get to skip the next month, so that's 2 payments. Then the third month, that's the first payment of your new loan. You make your first payment. Like I said, if you're already acclimated to your payment and you're comfortable with it, make the same amount. So you got your payment plus 150 going back towards the principal. And then those 2 payments that you didn't have to make, those should be sitting in your bank. Now granted, it's your money, you can do whatever you want with it. But if you take those 2 payments and then dump it on top of the principal at the same time that you make that first payment, you literally, through the amortization table, you'll see it, will take 4 years off of your loan, off of your new loan, right? So let's just do the math here. You bought the house, you lived in it for almost a year, right? So that means you have about 29 years left on your current mortgage. You refinance, that starts the clock over at 30 years. But if you do that little trick of just paying that extra towards the principal every month, and you take those 2 payments and apply it up front, you just took 4 years off of your loan. Now you have your payoff in 26 years. You just gained 3 years. So really, the $150 a month payment is inconsequential when you think about what the $150 can do for you over the course of the life of your loan, right? Now, granted, there's some people that are in more extreme situations. Let's say you're at a 7% rate and now rates are 5.5. Well, that's a 1.5 difference, right? On a $400,000 loan, that's $250, almost $300 less a month in payment, right? Now, some people, they need that reprieve. They overextended, they spent more on debt, you name it, whatever. So having that smaller payment helps give them some breathing room, lets them come up for air. But then again, there's other people who are like, hey, holy cow, I'm cool with my payment. That $300 now, that's gonna go towards principal. Now you're gonna pay it off even more or even quicker, right? And here's the other thing. Let's say, so from 2019 to beginning of 2022, rates were at extreme historic lows, right? I had clients that literally had refinanced 3 different times during those years because they started at one rate, was able to go down 1/2 to 3/4. The next time they went down another 1/2 to 3/4. And the last time they went another 1/2 to 3/4 to where we got them almost all the way down to 1.75 at one point, right? But they kept making the payment at what they originally bought. So that gap, right? They're just crushing. In fact, one of my clients right now was just telling me, he's like, Jay, I'm going to have my home paid off in 8 years. Holy smokes. His last refi was literally 3 years ago, and he's just crushing it. So it's just math, right? Einstein said it best. Compound interest is the 8th wonder of the world. Those who understand it make money. Those who don't, pay it, right? And that's the cool thing about the VA IRRRL. It's a very simple project. Now, here's the crazy part. Because you bought a home, you're public records, right? And there's a lot of folks out there that will just buy information, whether it's escrow companies, credit repair or credit reporting companies, the credit bureaus, that anybody's bought a home, and you'll get letters, postcards, you name it, all the time saying, "Dear John Doe, this is in regards to your," we'll just put cross-country mortgage loan, right? It'll make it look like it's coming from cross-country mortgage, but in fact, it is not. It is another company. You gotta make sure when you read the invitation, go all the way to the bottom of the page and see what actual company is. They've just bought information and they're trying to get you to try to come with them and refinance their loan. If you receive something like that, I always encourage my clients, just reach out to your lender. So my clients always reach out to me and they always send a picture. Hey Jay, did you send this? Look at my phone. Nope, guys, that's not for me. Remember, if you get something from me, it's gonna have my ugly mug on it. There's no mistake in this thing. And you'll know it's for me. Those are typically people trying to solicit you. And plus my clients know that when we complete a purchase, they know they're my clients for life. I'm their lender for life. And I monitor rates day by day. I've helped over 1,500 veterans in the last 10 years, which is quite a bit. And I'm always going to look for the best position. So I set up benchmarks or what we call strike points to where if I see the market is going to be an advantage to my clients, they know that if I text them, say, it's that time, they can expect a phone call from me. And I can tell them, hey, this is what's going on. This is where you're at. I think this is how we can help you. It's going to put you in a better position. So anyway, that's the VA IRRRL. A little bit about me. You guys have a great day, and we'll talk again soon. Aloha.